Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jared Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. And today we have joining us here Colby Fryar. Colby, thanks for joining us.
Thanks for having me. Appreciate it, Jared.
Yeah.
Appreciate the opportunity.
Yeah, no problem, man. Well, just a short bio here of Colby. He's the principal of Mountain Bridge Capital. He started investing in real estate in 2013 and personally owns over 140 doors of real estate, including a 12-unit multifamily property in Albuquerque, New Mexico, and a 123-unit portfolio deal in Las Cruces, New Mexico as well. He has been focusing on multifamily property investing and syndication over the past 5 years. Colby's background is in civil engineering. His experience managing multi-million-dollar contracts as a division manager has transitioned well into his ability to perform asset management on all Mountain Bridge Capital real estate projects. Well, that's quite a good bio there, Colby, and definitely have some experience under your belt. And if you would, before we transition into some of the details about the multifamily and apartments, and just share a little bit about your background. How'd you get into real estate and the transition there?
Yeah, no problem. So I started in civil engineering back in 97, I guess. I've been in it for about 25 years, 26 years. I currently work as a division manager, and a lot of that's been construction projects, multi-million, some of them multi-million, project management, all those kinds of things. But it's worked out really well, just having that experience, especially working with contractors. That's been really valuable in managing our contractors on these bigger projects, especially on the multifamily side, and an engineering background with the underwriting deals, and pretty good at spreadsheets. But I started buying single family 2013 and did the BRRRR strategy on a few of those, and so got some more management experience there, dealing with contractors and property managers. I think that was a really good foundation for what we're doing now in the multifamily side, which is just on a bigger scale, but a lot of the same things you're doing there. You're getting deals under contract, you're working with contractors, property managers, all those things that you got to do, and so that, now since 2020-ish, on the multifamily side, got a 12 unit in Albuquerque, then 123 units shortly after. The 12 was a JV deal. The 123 was syndication with 5 partners. And since then, we've done an 8 unit, also in Albuquerque, New Mexico.
All right. Well, and just to clarify real quick for the audience, so a JV is a joint venture. That's typically when you're just partnering with 4 people on a deal, and they pull their money together, right? And
that's exactly right.
Yeah.
2 or 3 people, maybe 4.
Yeah.
And it's a real simple kind of setup for the smaller apartment deals. So you don't have to have a syndication attorney, and you don't have to raise capital. You're all bringing in money together to take down the deal.
Yeah. Well, it's a good way to get that experience too, right?
Absolutely.
Yeah. kind of go through the trial and error before you start syndicating and start bringing investor capital um,
Yes.
into the mix
Yeah,
there.
you kind of get your feet to the fire a little bit on bigger deals, but not like you said, not with bringing in investors and raising capital. That's the big difference.
Yeah. Well, and so your primary focus is well, really you just said, I mean, you got a background, I mean, with the construction, asset management. But I know you're very skilled at the underwriting and you find these deals, underwrite them. If you could, so this podcast is tailored to the passive investor. So
Sure.
some of these are going to be new folks just starting out in this space, or some are, going to be some more seasoned investors. Again, just trying to educate. But if you could walk us through, when you find a deal, of course, you establish your market. So New Mexico, and I know you're looking in Tucson as well. Tucson, Arizona. But what's that process once you get a deal, once you find a deal, and just go through that underwriting process there, if you don't mind.
Yeah. So we really look for deals in those target markets: Arizona, New Mexico, Tucson, Phoenix. We're also looking in Texas a little bit, San Antonio, Dallas. Um, those are the major ones.
And real quick, Kobe, just on that, maybe why those areas? Just maybe a quick overview. What drives you to those markets?
Well, they're great markets. Overall, population growth, job growth, and they're relatively close, so we don't have to travel too far. Like we like it to be within an hour or 2 hour plane flight, if possible. Drivable is the best. So obviously we really prefer Tucson, Phoenix, but the reason for the bigger markets is it's harder to find deals right now, and so we've had to expand out just to bring in the deal flow and the deal volume, and it gives us more to look at.
Yeah, no, that makes sense. Well, and yeah, live here in Phoenix as well, and yeah, I mean, it's definitely hard to find something to pencil as of right now. But again, as you know, I think we're going to be seeing a lot of opportunity coming up in this next year. Um,
Absolutely.
once some of
Yeah.
these bridge loans start coming due, it'll
Yeah, and then on the underwriting, and so we look for what a lot of the syndicators are looking for. We want something that's got good value add, and so we have a set list of criteria that we go through for each of these deals. We're looking for value add. Obviously, it's Class C or B. 75 plus units is kind of what we focus on, and then if um, the markets like we talked, million plus metro areas with population, class, good areas, good rent growth, all those things. And if it passes that test, then we move on to see if it might pencil. And typically we do a quick underwriting to see if it's in the ballpark.
kind of
A
like the
lot.
back of the napkin type of deal, right?
Yeah,
Yeah,
that's a tricky one. It doesn't always work, but
yeah,
if you kind of know what you're looking for, you can at least see if it's in the ballpark and if it's worth looking at. I will say that it's probably better to go ahead and underwrite all of them because they're so nuanced and there's so many levels to every deal that it's hard to just pick a quick little tool and say, hey, that this deal doesn't work, this one does. But we're getting better at it and filtering those deals. And then if it still looks good, then we go to the full underwriting and kind of see if it pencils out. But we probably underwrite more often than not, going through the analyzer just to make sure that it's something that might work.
right, right. Okay. Well, so you find a deal, and then so population growth, job growth. You're probably looking at crime in the area. All these things,
Neighborhood level, yep.
neighborhood level. Income, and so all these things definitely play a factor into buying a property. And now you have again, this one, there are both of these properties in New Mexico.
Mhm.
Um, can you walk us through that deal there, and then what were some of those challenges, and how did you overcome them? Given the current market with the interest rates and things like that. Because if I'm not mistaken, the Las Cruces deal was fairly recently, correct?
Yeah, so we got pretty lucky as far as the interest rate on that one. We got a seller carry note. The financials were so bad at the time that we couldn't get a bank loan, and the way the property was situated, they were all split up into kind of portfolio style. So lenders don't really like to lend on that. So we ended up doing a seller carry note, 4% interest. I think it maxes out at 6 over 10 years, and 4% for 5 years, 75 LTV. Um, it was a heavy value add going in, and we had to move a lot of tenants out of there, but we've been in that one for 2 years, and it's cash flowing well now and doing well, and has been a good asset. So it if we had got a bridge loan at that time, it might have been a different story, because I know a lot of people are hurting. But thank goodness we didn't, because
And when that's what I was just thinking is thank goodness the bank wouldn't loan on the property, right? And yeah, we're forced to kind of look at some more creative financing there because yeah, as we know, Colby, we
yeah,
quite know quite a few of the same operators that are definitely going to be hurting here, if not already, with when these loans come due, because nobody saw the interest rate hikes going up the way they did, as rapidly as they did, right?
no, I don't think anybody could have predicted that.
Yeah.
Um, it's just it's a huge up. There's a lot of opportunity right now, put it that way. But I'm glad we're not part of that opportunity, and we have a pretty stable deal.
Yeah, well, and I think that's a good transition into, mitigating the risk, right? As far as
Right.
the underwriting models. So, obviously we all learned a lot with, these interest rate hikes and what happened in just the past 2 years. So, what are some ways in your underwriting process that you are mitigating the risk, because we're looking 3, 5, 7, 10 years down the road, right? So what are some things maybe you put into place?
Well, we, like everybody, we like to see a stable deal, something that'll qualify for an agency loan. One we're looking at and just got awarded in Tucson is an agency loan. Um, we're not opposed to bridge. I've been talking a lot about bridge lately, and you might say, well, isn't that crazy with everything we're going through? You still want to do bridge, but I think bridge can be a good tool if used right. And and the thing is, to take advantage of a lot of these opportunities coming up, bridge is going to be a necessary tool, because a lot of those deals are going to be distressed, low occupancy, and you're not going to be able to get agency debt on those. Saying that, we still prefer to go agency. It's the more stable, better option over time. But if that doesn't work, then getting a bridge loan with a 3-year rate cap, and making sure to buy that rate cap for 3 years, even longer, I think could be a good strategy, because the market's going to stabilize in a few years, and at that time, um, I think it'd be a good option to refinance into an agency. I don't, it's a bit of a gamble. People are saying interest rates are probably going to come down, but could they continue up? They could. But even then, with the bridge loan, at least it would be a more stable environment to where you could refinance into something with maybe a better cap rate, and return investors money, I think
Yeah,
is the thinking.
right, right. Well, and then when you say agency debt, are y'all looking at just fixed rate? So maybe 7, 10 year debt, right?
Yes, 5, 7, 10,
5, 7,
10 year
10.
debt,
Yeah.
and locking it's a fixed interest rate, so you lock that in for those 5, 7, 10 years.
Yeah. Well, and to your point, I mean, of the market stabilizing, I mean, it's a gamble to do that as well, right? Because you don't want to necessarily lock an interest rate in
Yeah,
at, you know, whatever 5, 6% or 7% even when it might stabilize and go down and you can get it for 3 to 4 here in 6 months, right? Or,
that is the
you know,
danger with that. If interest rates go down, then you have the prepay penalty, and it's going to make it tougher to get out of those deals if you want to refinance.
yeah.
You
What
have to,
what are you seeing investors feedback from investors as far as fixed rate versus bridge loans right now? And most experienced investors know what happened with these early 2021 2022 deals, so just factoring that in mind. Yeah, have you had it?
it's a very good point. And I just talked about bridge loans, but it's a bad word right now, honestly, and
Yeah,
people just really don't care. You can tell them anything you want about the getting the rate cap and all of that, but it is a scary word to them. And so I think people really want fixed, they want stability, they want fixed rate. And yeah, that's a fine line we got to walk with investors. They really don't want to hear that word right now. And operators, a lot of
yeah,
operators don't want to do bridge anymore, no matter, you know. And it could be a more attractive option because of the prepay penalties if interest rates go down. But um, it's just a hard time to tell people that right now.
yeah. Well, and that's interesting because I'm hearing majority of what you're hearing right now too from operators. I mean, bridge loan, like you said, you don't say that word right now with especially with investors. But I did hear one operator that was, they were, 15, 20 years experience, something like that. And they were doing fixed year debt or fixed rate debt, 5, 7 years on the 2021, 2022 properties. And now they're transitioning into bridge loans right now, which
Oh well,
was an interesting take on that. So you just which honestly those deals that they did, I mean, they're safe right now. They didn't get that interest rate hike like a lot of the others that
yeah,
did that bridge loan. So
yeah, a little bit ahead of the curve, it
look,
seems.
it did. Yeah, it does. But again, no, we don't have a crystal ball. Nobody knows what's going to happen. But being that we're on that topic, I was going to maybe ask you this towards the end. But what do you foresee, in the next coming year or two, and with multifamily and apartments, or specifically apartments? Where do you see us at, and maybe the
Yeah,
next 18, 24 months?
it's a good question. I see a lot of opportunity. I think now's a great time to buy, and it's a great time to buy to find a good deal, but it's not a great time to buy for investors because a lot of people are holding on to their money. But I think if we can get a deal at the right price, they're going to be worth a lot of money because we are on the downward part of that curve. I do think there is going to be some tough times ahead. Folks are, with the economy and everything, but I think multifamily is positioned really well to withstand that. And we're going to find some great values, and those properties are going to be worth a lot of money in probably another year, 2 years. It might take longer, but they're going to be worth a lot of money down the road. I think now's the time to do it.
Yeah, no, I definitely agree with you. And it's fortunate and unfortunate, right? Fortunate that there's going to be a lot of deals on the table here in the next 6 to 12 months. Unfortunate where some of these operators that didn't buy a rate cap on their deals or didn't structure it, or what's sad is some of these operators are executing their business plan just like how they projected, but even that, with the interest rate hike,
Yeah.
they're still not able to be in a position to get their DCR, their debt service cover ratio, in a position where the banks will refinance or even to sell. So yeah, it's
Yes.
yeah,
Yeah, you having to cash in on the, do a cash in refi if they can afford to do that.
yeah,
Um, if not, maybe the banks will work with them to kick the can down the road a little bit,
yeah,
work some kind of strategy out, or I guess the worst case is foreclosure, where if they can't afford to extend the loan or refi the loan.
right. Yeah, and I've even heard of some operators looking at like pref equity, bringing some more
Yep.
equity in. To your point, just kick the can down the road a little bit, and which may dilute investor returns, but at least they're not losing the capital, right, or foreclosing. So
Yeah, that's the thing you want to avoid if at all possible.
right,
I think I think there's quite a few of those that will have that option. I think there's some that they're so bad that I don't. I looked at one the other day. It was incredible the amount of money they're losing a year, and I don't know that there's any good option for that one, unfortunately.
yeah. Once you get so far behind, there's just it's hard to come back from that, right?
Yep.
Yeah. Well, let's kind of a couple more questions I want to ask you on the underwriting side, and then we'll transition into our final four questions here. But can you share some red flags that might make you recommend against investing in a particular property? I mean, what are some just like glaring things like, oh no, we're done here? Like, yeah, what you have anything in mind there?
Neighborhood, kind of a class, if you get into class D, um, homeless kind of situation, I think those are red flags. If you have a lot of homeless around, of course, homeless is getting more prevalent in cities now. So, to say that you wouldn't buy a property just because there's a few homeless around, that's probably a misnomer. Um, but to have homeless in the units, I think is a big red flag. Um, I think some of those could present opportunities, obviously, but if you're looking for a stabilized deal, that's definitely not something you want to go for. Low occupancy deals, um, you got to be careful of. Um,
Yeah, you want to
a
buy,
lot of
especially if you're doing
concessions.
value add, you want to buy a cash flowing asset, right?
Yes,
Yeah,
these cash flow
mm,
day one.
they want, yeah,
I think that's a red flag, is going into a deal that maybe negative cash flow year one. If you're going after a deal like that, it better be a really good deal.
right.
Because you're gonna have negative cash flow. Concessions are another one. Look at concessions.
And
Uh,
for the listeners that don't know what concessions are, can you explain that a little?
at a lot of properties right now, the owners are offering 1 month free, or so much off every month, just to try to get people in the units. And so that's one thing you want to be wary of going in if they're offering concessions. If there's a lot of delinquency, a lot of bad debt on the books, is another red flag to look for. Um, and then the occupancy is huge, obviously. Yeah,
Yeah. Okay.
areas
Yeah.
hard to evict,
Right.
places.
Which, and I imagine a lot of this you're doing up front, when you're narrowing down your market. But, I mean, just like Phoenix here, have 2 square miles I mean, there's $1 million houses in the area, and then 2 square miles where there's homeless walking around, right? So you definitely,
Yes,
you know, definitely got to be aware of that too, which of course, being an operator, they're like Colby is definitely going to look for that before they, get a deal under contract, right?
doing your due
Yeah.
diligence. Yeah,
Yeah. Yeah. Absolutely.
making
Oh,
sure. Looking for deferred maintenance is a big one when you walk a property, and look at broken windows, a lot of traffic, all those kinds of things are huge red flags.
yeah. When I gotta imagine, say, you get under contract and you're starting to walk the property like you're saying, looking in the units and things. I mean, have you run into situations where like you know, the roof's, oh my goodness, the roof's going to have to be replaced on this, apartment building. And I mean, roofs aren't, cheap on on an apartment. So like, does that
Yeah,
throw you?
that's a
Yeah.
big one.
Yeah.
One of the big ones we had in Las Cruces, and we we should have done a better job on. We did inspections, but our inspector didn't really do a good job of looking at the exterior. We were so focused on the roof, so focused on the interiors, we forgot to look at the balconies and really look at the structure of those. And there was some real problems with the beams twisting, and there was too much weight from is what ended up happening was the weight of the stairs on those balconies was causing them to fail. And so we had to go in and put new supports on that. And that's really something that should have been caught during the inspection and due diligence. But
Yeah.
you gotta, the lesson learned is look at everything on the property.
Yeah. Well, and this is that, live and learn type of situation, right? Now, next time
Right.
you're gonna pay more attention to the balconies and the, construction of or the structural, things, the beams and stuff like that, right? And I'm sure
Yeah.
you still get a structural, get like a structural engineer out there as well and
Yeah.
have them look at it. Yeah,
Always a good idea to have a structural engineer look at everything.
right.
You want to look at the plumbing, you want to look at the electric, those are all huge.
Yeah,
HVAC, boilers, chillers,
yeah. Well,
all that stuff.
and I'm curious, like, do when you factor in underwriting, and I know some operators use this, but like low efficient toilet or high efficient toilets, like or water, spigots and things like that, just to help with the water flow. Do y'all, whenever y'all are doing your capex, do y'all ever add any of those into your properties?
Yeah, we look at that a little bit.
Yeah,
Um, that's helped us a bunch in Las Cruces. We did the plumbing, the plumbing repairs alone were huge in reducing our water bill, just because of the deferred maintenance there. But then adding in those low flow toilets and low flow faucets and all those things, you can really get a good savings.
yeah.
But you have to be careful with older plumbing. Sometimes those things don't work, so it has to be compatible.
Yeah, no, that makes sense. So yeah, certain building up, then that's when you're probably factoring that in. Well, and I share that just because, when I mean, with multifamily, you can add so much value. I heard like on 128 units, they were going to add them in every single unit. It added about, well, I can actually, what, I take that back. I can't remember the unit number, but it was like $128,000 a year that they were able to save, or maybe throughout that whole period in the five
Uh-huh.
years, and essentially that adds value to the
Huge value,
I mean, right,
right to the bottom line.
to the
Yep.
bottom line, right, and so I mean, yeah, because the banks lend on this net operating income, and then that's how the property's valued as well. So which
Yeah.
is a benefit to multifamily, unlike single family, right, where you're comped around the neighborhoods at value,
Yep.
Um,
Yeah,
so
that's a great thing. Multifamily, anything we can do to reduce the expenses, increase the NOI it goes right to the value of the property.
right. Yeah, I think on this one he said, and I wish I could remember the unit number, but it was like $3 million value over that whole period in time. I mean, just by
Wow,
adding that stuff. Yeah, I think it was a lot larger
that's
unit number.
incredible.
Yeah, it was pretty remarkable there. Um, so and it might have been a portfolio now that I'm thinking about it, but still, you get the point.
Yep.
So, all right, well, let's do this, Colby. Let's transition into our fire round, is what we're going to call
All
it.
right.
Going to be 4 questions here that I ask you here. And the first one is, could you recommend a book on real estate for investors just starting out, and another book that is particularly good for cultivating a positive mindset?
Good book for real estate investors starting out. That's a good one. I would say probably At least on the multifamily side, I'd recommend the Joe Fairless best ever book on apartment investing. Very detailed, a lot of information in there, but it gives an overview of all the steps and all the different types of multifamily. I think it's a great book. The other one would be Ken McElroy's ABCs of real estate investing. That's a good one too.
Yeah.
On the mindset side, definitely I would recommend Robert Kiyosaki's book, Second Chance. It's there's Rich Dad Poor Dad, which is a great one, and it's very similar to that. But I first, I was in the library about 10 years ago, and it actually started me on this whole journey. And I found that book, Second Chance, and it really changed my life. It was an amazing book, so I highly recommend it.
Yeah, I thought you were going to say Rich Dad Poor Dad, but I'll have to check out Second Chance. I've never
And I would have probably read Rich Dad Poor Dad had that book been in the library, but
right.
it was on the shelf there, and I picked it up and read Second Chance. So
Yeah.
I think it's very similar.
Probably, yeah. When he's got the cash flow quadrant too, which is another good one.
Yep.
But yeah, it's just that total mind shift too. It just makes you think in a totally different perspective and have a new outlook on life, really, and
Yes.
sustainable.
Yeah.
And yeah, I just want to mention too that Joe Fairless book. Yeah, I actually have that right here next to me on my bookshelf, and it's a
Oh yeah.
great resource too. It's you can reference it, and yeah, it's just not a one time read. So
Yeah, it's like one of those that you sit on your desk, look at whenever you need to pick it up.
yeah.
Ton of information in there.
Yeah, well, and to your point, Colby, there's a ton of there's like key terms and things. I mean, there's a ton of resources just because when you get in this apartment world, we use these terms that you probably have no idea what they mean, when you're first getting into it. So they got a glossary of what the terms and all the definitions. It's just, again, it's a great
Gotta
reference.
learn the language.
Got
That's
to learn the
huge.
language. Yep, exactly. All right. Next question here. What is a practical first step the audience can take to explore the space of passive investing?
A practical first step to explore passive investing. Well, there's a lot of resources on that as well. I read that book, The Hands-Off Investor, by Brian Burke. Great book. I would highly recommend that. And then I would look into the operator is a big one. So really focus on trying to nail down experience level and trust, and get to know the people you're going to be investing with before. I think I would spend a lot of time doing that, just getting to know operators up front before ever investing.
Yeah. Well, and maybe, yeah, just picking some operators that, you feel are good qualified sponsors, and just call them one every week, right? Just getting to know them, get on their email list.
Yeah. That's a great idea.
Yeah, just like Mountain Bridge Capital, right? Call Colby and just have a conversation with these guys, because all of them, especially next year, there's going to be a lot of good deals coming up. But you want a good operator in place that's going to be able to execute this business plan, right? And they always talk about the know, like, and trust factor. So so glad.
Absolutely.
Yeah. And and two, just to add on, Colby has a meetup actually in Tucson.
Yes.
That if anybody's down there, a great way to get started as well as getting to know people is going to meetups. So if you're, ever down in Tucson, or you're not in the area, just go to a local meetup to get to know people. But I do know, and I've heard a lot of great things about Colby, so definitely
Appreciate that. Yeah. I appreciate that very much, Jared. And I totally agree. I think the meetups are, out of everything you could do, going to a meetup is really huge on the education side. And then just the networking, the people you get to meet there, and that are like-minded and doing the same thing you are. And we try to keep it educational and help people out. Whatever they're doing, they may not be interested in the passive side, but if they're interested in smaller multi, then we have that for them. Or if they're interested in single family, it's just a way to maybe broaden their horizons. One day they're starting to think about where they can go and all those things. So it's a pretty cool way to help people out in a lot of different areas.
Yeah, no, definitely. Well, and getting in this space, it's so amazing on how many people are just willing to help you, right? Because they've been where you're at, and they know what it took for them to get where they're at, right? And so a lot of
Yeah.
people are here to help you along the way. Like
Oh
Colby
man. Yeah.
said, regardless of what single family, small multifamily, the bigger units. I mean, there's someone there to help. Well,
Oh yeah. Yep. And you're exactly right. Everybody's just in this space lifts everybody up. You rarely meet a jerk. Everybody's
yeah,
really good people
yeah, definitely.
for the most part.
Yeah. Which kind of brings us into our next question here. What is a daily habit you practice keeping you on track towards your goals?
Probably the best thing that's helped me out is well, number one is a calendar, a weekly calendar that I do every Sunday, and I lay that out what I'm going to be doing the whole week, and that way all your appointments are in there, all the things that you have planned, and then you time block your time during the day to really focus on those things that you want to get done, um, and need to do your meetings, and then also the underwriting, the talking to brokers, and you know, on the passive side, it'd be trying to find those operators, find those deals, put that time in there. And then the thing I do every day is I focus on the three things that I want to do, and I write those down every morning. And those are the three things that I need to do to move my business forward each day. And so I make sure I put those down, and I have to do those each day.
I do a very, very similar habit as well. I do mine on Sundays too. And it just lays out the week, right? If it's in the calendar, you're going to do it, right?
Yeah.
And and two, and that's just in business. I mean, you can do this in all areas of your life, right?
Yep.
Your gym, family time, you're still working a W-2, so you got to factor that in as well, right? I mean,
Yes.
we get pretty,
Makes
and
it even more important.
I know, and you got three kids too. I know. So like, yeah, we just
You got to
um,
plan that in too. Your
gotta
family
plan.
time, all of it.
Absolutely. So needless to say, we stay pretty busy. So it's, definitely important having it all in a calendar. And like Colby said, just write down those top three things you need to accomplish each day that's going to move you towards your goal. To that
Yeah,
one thing, right? Yeah.
that's a key point right there. Is that it helps maintain that balance too,
Yeah.
because you've got so many different priorities that if you didn't have it on a calendar, it would be hard to put any focus on every one of them. And so, and just to keep the balance in your life with family and work and exercise and all those things, um, having it laid out on your calendar, it makes you do it. And so I found it really helpful just to stay on track in all areas.
Yeah. Absolutely. So, all right. Last and final question here. If you could be remembered for one thing, what would that be?
I think I'd want to be remembered as an educator and somebody that really tried to help people no matter what they were doing. Um, Whether it's through a connection or giving them some advice to help them on their journey, get them to the next step, and just be a part of their journey. I think that would be huge. But that I think that would be it for me, is helping people and helping to educate them.
Yeah. No, that's great. And I mean, it's just giving back, right?
Yeah.
We're just helping educate others on what we've learned throughout our lifetime, and kind of going back to what we were talking about with real estate is we've all been that new guy just starting out, right? And now we can help the other new guys that are just starting out to get to this space now that you have almost 10 years of experience and, 200 plus units under your belt, right? And probably
Yeah,
more. Yeah. Yeah. That's awesome. All right,
and
cool.
that is the
Yeah.
fun part is showing people how to do it, and helping them to learn. I get a lot out of that, just seeing them grow.
Yeah. Yeah. There's nothing like just seeing that light bulb come on in somebody, right? And just,
Yep,
kind of like when we read that, The Second Chance with the Rich Dad, Poor Dad, right? You just kind of, get that mind shift. So,
absolutely.
yeah.
That's huge.
Yeah. And then you got people in the space like Colby that'll help kind of walk you through. And, there's a lot of mentors that are just willing to, they just want to help you succeed just like they have. Um,
Yes,
you know, all right,
absolutely.
Colby. Yeah. So, all right. Well, if you would tell listeners how they could connect with you, find more about you. Um, yeah.
Yeah. So my email's colby@mountainbridgecapital.com. And Jared mentioned my website, Mountain Bridge Capital. You can reach me there. I mean, on LinkedIn as well, and Facebook. So any of those is good.
All right.
Love to connect. And I'm not real good on Facebook, but I try to check it as much as I can. And so probably email would be best.
Right. Well, yeah. So email Colby if you want to connect, and I highly encourage you again if you're in the Tucson area, go check out his local meetup there.
Yeah,
What's
we
the,
meet
what's the name of it? Yeah.
It's a Tucson multifamily meetup. We're on meetup.com, and I also advertise that on Facebook and LinkedIn. And we meet the first Thursday of the month at Fire Truck Brewing on East Grant Road.
Perfect.
Yep.
All right. All right, Colby. Well, thanks again for joining us today. I think listeners
Awesome.
got a lot of this podcast here, and well, until next time.
I really enjoyed it, Jared. Appreciate you having me on. Thanks for the opportunity.
Yeah, thank you. Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.